Trading Hour. I'm Reema Tendulkar. With me, Sumaira Abdi and Pavitra Pari. Good morning, girls. Looks like we've still got a bit of a Fed hangover right now for our markets. We're down 1% on the benchmark indices. The banks are underperforming significantly. The Nifty bank is down close to about 2% The advanced decline ratio is well in favor of the losing side. We've got nearly one stock in the green for about 3 stocks currently in the red. Let's get those charts up for you on your screen. Asian markets continue to bleed. The Korean markets today have taken the biggest knock. They're down close to about 1.5% for the week so far. The likes of Kospi are showing you cuts of close to about 3%. But even the others, like Hang Seng is down 0.4% today, as you can see. But for the week, it's down nearly about 3.5%. So across the board, this has been a rough week for the equity markets. And Indian markets today are down at that 17,450 mark. The level to watch will be this week's low of 17,429. We've got there. We're almost at those levels. Let's see whether we can hold on. We are at a very critical support level. Hi.
Hi, good morning. You know, when the market opened, we were getting excited about the fact that there's really not too much of a cut, at least compared to what's going on globally. But from the opening levels, the Nifty is down around 140 points. The Nifty bank is down almost 600 points. So that's the kind of slip that we've seen with really no recovery along the way. So a couple of stocks that we are tracking today, of course, it is the IT pack, which is in focus. Some of the pharma names continue to do well. So those ones will come up for you on your screen. And then it is the Fmcg stocks, which are continuing to hold strong. In fact, if you take a look at it on an index level, the Nifty FMCG pack for this week is up 4.5%. So that's what's happening there. It's looking quite strong. A few of those stocks will be up for you once again, holding on well, HUL, Britannia. And then on the downside, you have the Nifty Bank. For the week, the Nifty Bank is down 2.5%. So do keep this on your radar as well. And then, you know, there's so much stock-specific news today, whether it's the entire Tata Group, Tata Steel consolidation plan that we're tracking, or what's happening with the NBFCs. But Sumaira, one way or another, we have ourselves a packed Friday.
Yeah, we do actually, and it doesn't feel like a Friday so much this time around. But anyway, let's tell you all that we have lined up for you today. Markets open lower in line with global cues. Autos and financials are the biggest losers. Defensive shows strength. We'll be joined by Ashutosh Bhargava of Nippon India Mutual Fund to talk about the outlook for the market from here on.
Tata Steel gets set to merge 7 metal subsidiaries into itself. These include the listed arms of Tata Steel Long Products, Tin Plate, Tata Metallics and TRF. Later on the show, we'll get you all of the details along with some management commentary from our exclusive conversation earlier today.
Accenture's Q4 earnings have come in line with street expectations, but the IT giant's revenue guidance of 8 to 11% is below estimates and signals moderating growth momentum. We'll be joined by Omkar Tangsale to talk about what this means for IT stocks in India and the outlook for the sector at large.
And the RBI bans M&M Financial Services from outsourcing recovery and repossession operations. This comes after a third-party recovery agent engaged by the lender allegedly ran over a pregnant woman in Jharkhand last week. The stock has tanked in trade. We'll get you more on this in just a bit. So all of this and lots more over the next 60 minutes.
And IT stocks are on our radar today on the back of Accenture's Q4 numbers. Q4 numbers came in line with consensus expectations. The key that the street was tracking was the FY23 guidance, because this is the first sneak peek into what IT companies are likely to do in the next year. It gives you an indication of demand, and FY23 revenue guidance by Accenture has moderated. The company is now guiding for an 8 to 11% revenue growth, which is significantly less than the 26% growth that the company recorded in the year gone by. Now, Accenture gets about 50% of its revenues from outsourcing and consulting. If you look at the breakup between that, consulting order booking was weak, but the outsourcing bookings were very strong. Outsourcing bookings went up by 44% on a year-on-year basis last quarter. And this is a proxy for Indian IT companies, because we are outsourcers. And the company has said that outsourcing revenue growth will be in double digit for next year. The IT sector today has, reacted positively. The sector is up. The Nifty IT index is up close to about 0.9%. It's also aided by the sharp rupee depreciation that we've seen. To talk more about IT, we're now joined by Omkar Tangsale, the senior research analyst at Axis Securities, on the show now. Omkar, morning. First, your thoughts on Accenture. What, according to you, is the biggest takeaway? And how would you read the weakness in consulting? Because while the Indian IT companies do not directly we do not have a direct exposure to consulting revenues the way Accenture does, but consulting is seen as a lead indicator for discretionary technology spend. So when consulting revenues slow down, there is a probability that eventually down the line, tech spending will come under pressure. So your thoughts on Accenture?
Yeah, I'm positive about the Accenture results for Q4 FY22. However, the only concern about me is the moderating the growth because of the uncertainties from the world's largest economies of the world. That may moderate the growth performance that FY20 that Indian IT services also has been likely to be concerned. One point of view that one should look upon as the deal wins came at 18.4 billion, which versus $17 billion in the previous quarter, which continue to be robust, and demand for the outsourcing has remained resilient in spite of the uncertainties from these economies of the world. So I believe the demand for as businesses becomes depending more on the system driven, and the dependence is getting higher. So the dependency will likely to fetch more resilience in business in terms of outsourcing. However, because the uncertainties will lead to the more discretionary spend cuts that will likely to be happen for the next couple of quarters at least.
Omkar, good morning and thanks for joining us. This is Pavitra. You know, so far what we were really discussing was the margin pressures, but this time, even with Accenture's sort of revenue guidance, it does seem like demand concerns are also now going to start showing up. How much do you think you could see demand moderating for some of the larger IT Indian players?
I believe the demand will likely be consistent as they have grown previous quarter. For this quarter at least, the growth we can see at around 0.5 to 3 or 4% of the growth for the quarter-on-quarter basis for this quarter. But next couple of quarters, quarter 3 and quarter 4 will likely to be one should look upon vigilantly while the spending gets coming from the verticals that they are fetching.
All right, Omkar, do stay on. We'll just come right back to you. But there's some more news that Rima wants to fill us in on. With several brokerage conferences in recent days, we've been getting a lot of comments from key IT companies amidst rising demand concerns across the sector. So today, the focus is on HCL Tech. Rima is once again back at the big wall with all the details. Rima.
Thanks so much for that. Well, you know, for HCL Technology, one of the most attractive features is its valuations, which is cheaper than peers. So let's pull up the valuation picture for FY24. HCL Tech at 15.5 times has always historically traded at a discount to peers, and this time as well it is trading at a discount, as you can see. Now, last quarter's numbers were a particular miss on the margin front. Margins for HCL Technology came in at a decade low, and this chart here will show you how the margins have fallen from their post-COVID peak. In fact, at one point of time, the margins were as high as more than 22%. And the street was worried that after a 17% drop-off in margins in Q1, can the company meet its full-year margin guidance of 18 to 20%? So on the topic of margins, this is what the management had to say. They said that Q2 margins will be better than Q1, despite the wage hikes and attrition, which means quarter on quarter there could be some expansion on the margins. The company is still on the hunt to achieve the lower end of their FY23 margin guidance of 18 to 20%. So they're holding on to the margin guidance, but it's going to be at the lower end. And the focus, the CEO said, is on improving margins over the medium term, once the supply side situation is perhaps eased. On growth, the HCL Tech management is fairly confident about achieving its FY23 revenue growth guidance of 12 to 14%. That's the guidance for the full year. They say that despite the macro volatility, the uncertainty, the pipeline has seen a very strong conversion so far this quarter. The demand is solid in the near term across all parts of the business, except for segments such as mortgages and the department stores. The big change in the management commentary is the percentage of cost takeouts in terms of deals versus the transformation deals. And now what the management is saying is that we're seeing more of the cost takeout deals versus the transformation deals compared to just 3 quarters ago. And finally, as we wrap this up, a quick word on what the street is going to be watching. Will the company be able to meet its margin guidance? It appears to be a tall task. Not everyone on the street is very concerned. And secondly, it also has a very high exposure to engineering R&D, ER&D as it's called. In the past macro cycles, the ER&D outlook has been impacted due to the macros. This time, the management is saying it's going to be different, but the street is going to be watching out for the ER&D outlook for this year as well as next year very closely. Back to you.
All right, Rima, thanks a lot for that and taking us through that entire explainer. We still have Omkar with us. Omkar, you just heard that entire explainer. You know, on HCL Tech specifically, if I can come in, we did get margins last quarter, which was, at 17%. It is a historical low for the company and significantly lower than the 19-20% that we've seen. So what do you think about the margins for HCL Tech, and do you think that we've perhaps seen the worst of it?
Yeah, and for HCL Tech, the margin is likely to be some of the acquisition rate or because of the rising concern of the other levels. My major concern about is that reported Q1 is not from the IT as a whole as compared to its peers, but I believe the growth came largely from the product and platform business and the year-end spend that they have incurred. The product and platform business are largely volatile in nature in terms of the consistency, and the year-end spend cuts will likely to be remain vigilant or let's say volatile for the next quarter as we can see, and spend cuts from because of the uncertainties from these economies and from the geopolitical tension from the European region. So one should see how IT services as a whole or motive business will likely to be how it is performing and picks up as compared to if it picks up, then definitely
Omkar, I'm going to have to cut you there. I'm very sorry. The audio is really poor. We're going to try to reconnect and, get you on a better line, but we're really having trouble hearing what you're saying. So let's quickly get into a short break. Our team is working to repatch that connection. We'll be back, and hopefully Omkar will be back with us as well. Hey guys, welcome back. You're still tuned into Trading Hour on CNBC-TV18. Now let's talk about some stocks which are really in focus today, and Mahindra Finance is one of them. It's tanking in trade, down over 10% after the Reserve Bank has asked it to stop using recovery agents following the tragic Hazaribagh incident. Abhishek is here with all of the details. Abhishek.
Well, as you mentioned, RBI has taken action against M&M Finance. So they have directed M&M Finance to stop recovery operations via third party until further order. So there's no definitive timeline given over there. M&M Finance can carry out recovery and repossession activities via their own employees. So they have an employee base of about 19,747. M&M Finance has also come out with clarification wherein they mentioned that they have stopped third-party repossessions, and they will further examine as to whether and how third-party agents will be used in future. So they have, lost out on repossession of about 3,000 to 4,000 vehicles out of the 4,000 to 5,000 vehicles that they repossessed every month. So they see an impact which is almost 60-80% over there. We have reached out to Shriram Transport as well on this news. They say that, our all vehicles dispersals and recovery are done in-house. So there is no vehicle repossession done via third party. We also wrote to Chola Mandalam, who have told us that they have a total strength of 13,000 in-house employees for collections as well as recovery. And they have external agencies as well, wherein they have 1,500 agents for repossession. But all these 1,500 agents that they have are always accompanied by their in-house employees as well. Back to you.
All right, Abhishek, thanks a lot for taking us through all of the details there. A quick look at the market. We're currently around 215 points lower on the index. For the Nifty Bank, that is the worst faring index, it has slipped even more. So it's currently around 960 points in the red. It's a 2.3% cut that we are seeing on the Nifty Bank. Let's also bring in our market guest for the day. Ashutosh Bhargava, Head of Equity Research and Fund Manager at Nippon Mutual Fund, joins us now to discuss the fundamentals of the market. Ashutosh, good morning and thanks a lot for joining us. This is Pavitra. The big theme that we have been discussing is how India has seen a significant outperformance compared to what's going on in the rest of the world in global markets. What is your sense on this? Do you think this kind of decoupling can continue for a while longer? Because in the past, whenever we've seen this kind of decoupling, it's only a matter of time, right, before the catch-up really happens.
So you are right. I mean, decoupling don't last forever, and we have seen multi-months of decoupling, and not only in terms of equity markets, but in fixed income market or currency, we have outperformed. But if I just keep my prejudice aside, it is also suggesting that some of the country risk premium, which world used to assign to India, has come down on a relative basis. Definitely on growth, inflation trade-off, we are doing much better than most economies at this point. As far as market is concerned, if you divide market into the segments which are domestic demand oriented and the segment which are external demand oriented, this clearly you can see there is no decoupling in sectors like tech, etc., which are also falling and have fallen in line with global tech stocks. The only decoupling or the outperformance that we talk about in India's case is owing to these domestic demand-oriented sectors. And now it is now a well-discovered and well-discussed theme. So to my mind, if Europe or China, if these economies suffer a bitter recession, then for me it is very hard to imagine that this decoupling theme would continue in our market in that kind of environment could deliver very solid returns.
Okay, so you're not buying into the decoupling theory, and you do anticipate an impact of slowing growth in US and Europe to impact India. So in that context, Ashutosh, what is the best approach to making one's portfolio? How do you hedge yourself against the possible impact of a global slowdown?
So in our asset allocation funds in this framework, we have cut down on equities because of high valuation, and for the short term, we think that fixed income also offer a decent hedge given the valuations are and given global uncertainties are. That's on the asset allocation part, that we are far more balanced and equity allocation are lower versus what they were in the last 2-3 months. In terms of portfolios, obviously still we favor stocks in sectors which are domestically geared. So we understand that there are concerns about rupee and domestic liquidity. We still like banks, for example. We still like urban discretionary stocks, for example. So we're clearly staying away from global demand and global price-oriented sectors, keeping in mind that, yes, some bit of damage in those stocks has already happened. Still keeping a faith in domestic demand stories, like banks, cap goods, autos, and other discretionary retail and other sectors.
Okay. Hi, Ashutosh. Morning. You've been tracking, I assume, the NBFC story today around M&M Financial. I mean, the stock itself is down 11%, but it's bearing down on other stocks as well. Now, some of the NBFCs have spoken to us saying that they don't have any outsourced recovery agents. Some of them do have. Do you think this could snowball into a bigger issue from here?
So our understanding is that, it might not be a bigger issue if you start looking at, from medium to long-term perspective. But on a broader point about NBFCs, when we look at the broader financial, at this point of the cycle, we clearly favor banks over NBFCs, because if you look at banks, you don't have as much of margin pressure. In fact, this cycle, we are not seeing any margin pressure whatsoever. In a rising interest rate environment, NBFCs have this disadvantage. So considering that and the fact that, credit growth is picking up, valuation for banks are perhaps very reasonable as compared to NBFCs. So we are favoring banks over NBFC, and that you would see in most of our portfolios.
All right. Another space I want to ask you about is the FMCG space. In recent days, we have seen quite a run-up in a few of these names. Of course, still very expensive, but do you think a few of these become attractive now?
So which space you talked about?
The consumption space, the FMCG stocks?
Yeah. See, the FMCG might not offer a lot of absolute upside, but if you believe that there could be a bout of volatility, some consolidation near term, that could be that safe haven The only fundamental factor I can think of for FMCG is that there could be some margin support. They had suffered a lot of input cost inflation, and that the margin is subsiding, in fact, subsiding pretty fast. So you could see less of an earning risk, in fact, some support in the earning as we get into the second half of this fiscal. Apart from that, I think from valuation perspective, there's little to be really excited about this space.
What about IT, since you are worried about a global slowdown, and many of the large leading leading companies globally, FedEx, Ford, Walmart, Target, so across industries, even a couple of steel and material companies, US Steel Corp, etc., they've all pointed to a hit on demand, either due to inflation or due to what's happening in Asia as well as Europe. Which are the companies which could get impacted in the IT space due to a large exposure to any of these top clients who have, top clients where issues have surfaced?
I can't talk about individual company, but one thing I can share is that, yes, there has been correction in terms of valuation. There has been derating. But as a house, we still see scope for earnings cut in the sector. I don't think that is properly baked in. Given the news from key geographies like US, Europe, that is continuously worsening. So to that extent, I think there is still scope for earnings to cut. And therefore, perhaps despite underperformance of this sector, one should not become too excited about it. And the other point has always been supportive for IT stocks is INR weakness. But this time, even that support is not pronounced because from cross-currency perspective, there are many other currencies against which INR has appreciated significantly, like Euro, JPY, etc. So that support is also negated. So I think there is one more round of earnings cut, which is possible in a foreseeable future. And perhaps after that, the risk reward for the sector may turn much favorable.
All right, so that is the word on tech. You were also, another thing that I want to ask you about is you did mention that you're not looking too positive on the FMCG space. Is there anything else that you feel is completely best avoided at a time like this? And, it's perhaps too risky to be in those sectors?
Not really. One good thing which has happened in the market is that, wherever there is positivity in terms of cyclical recovery, that those segments have been doing very well, and their valuation reflect that optimism. And wherever sectors like, tech, metals, etc., where there is challenges as far as earnings are concerned, they have beaten up. So to that extent, I think market is fairly discounting positives and negatives well. So at this point of time, other than being a bit cautious about the overall market construct, any particular sector where we are extremely negative, the answer would be no.
Okay, Ashutosh, we'll leave it at that. Thank you very much for joining us. Looking forward to chatting with you more often on Trading Hour. Thank you and have a good weekend. Get into a break on that note. When we return, we'll discuss market technicals. Mitesh Thakkar joins in next.
Hi, welcome back. You're watching Trading Hour. Joining in now is Mitesh Thakkar of earningwaves.com. Hi, Mitesh. Thanks very much for joining in. So it looks like that from the low point, we're bouncing off a bit. Do you see this sustaining, and what's the trade now?
Yeah, good morning. So I think we have seen some bounce back from levels closer to about 17,400, the low being 17,413. but we don't have a sign of a reversal as yet, which means that we're not sure of, that the market will reverse. So I think I'll keep 17,400 as the level to watch. In case we see a reversal sign on the hourly chart, then maybe go long. But till then, I think trading with stock-specific biases, and pharma is the sector on the long side, along with IT to a certain extent, while other sectors we're exploring more of shorting opportunities.
Stocks, Mitesh?
Sorry, can you repeat that?
No, wanted to know your stock-specific approach this Friday.
Sorry. Yeah.
And how long would you hold it? Would these be day trades that you would look to unwind before the weekend?
No, I think these are typically, the kind of trades I recommend are typically for about 2 to 3 sessions. Sometimes maybe more, slightly on the swing-based parameters. So I have a buy on Sun Pharma, which I would recommend buying with a stop below 908 for targets of 960 on the upside, and that's nearly trading at the day's high in a market which is very weak. And a sell on SBI cards, which is breaking down. So keep a stop at about levels of 940 here and look for targets of around 881.
All right, buy on Sun Pharma and a sell call on SBI card. Mitesh, thanks a lot for joining us with that technical check. We're going to get into a short break now, but when we come back, the Tatas are all set to amalgamate their metal companies into Tata Steel. More on that as well as a word from the management when we come back. Welcome back. You're still tuned into Trading Hour on CNBC-TV18, and let's bring you some interesting market opinion. We spoke with a host of market experts this morning, including Suresh Tantia of Credit Suisse. So let's listen in to what he has to say.
I think you would see some outflows from India, especially as investors are now getting worried about INR depreciation. The interest rate, the differential between India and US are widening, and that could put further pressure on INR. And RBI is very hesitant to hike rate more aggressively compared to what other central banks are doing. So that might lead to some outflows from Indian equity market, especially as the market has done well and valuations are not cheap. Certainly, I think one should move away from equities to bonds because now bonds are looking much more attractive. Even within the Indian equity market, I think bonds are yielding better compared to the equity valuation. Nevertheless, I think you can't completely get out of the market, especially given the strong economic growth outlook that we have in India. But I think within the equity portfolio, one can readjust from companies which are exposed to global slowdown to a domestic place. Those would be sectors like FMCG or the banking names, which could continue to do well given the strong economic recovery. On the other hand, sectors like technology or commodity names, they could come under pressure as the global slowdown continue.
Okay, let's now get back to the big story this morning. Tata Steel gets set to merge its listed metal subsidiaries to simplify the holding structure and make the most of synergies. Nigel is standing by at the big wall to tell us more about their consolidation plan. Nigel.
Well, the long-awaited big consolidation drive at Tata Steel has finally been announced, with listed entities like Tata Steel Long Products, Tinplate and Tata Metallics. They're going to be merged with its parent, that's Tata Steel. Now, Tata Steel has majority stakes in most of these companies, though in TRF, they have little over 34% stake. The merger ratios that were announced, they come up for you on the screen, and they were more or less in line, barring TRF as well as Tata Steel Longs, where the merger ratio was unfavorable, which explains why both those two stocks are under pressure post the big run-up that we have seen in the past couple of weeks to the last 1 month. Additionally, Tata Metallics is also hit in trade, as the street believed that bulk of its EBITDA came from non-commoditized DI pipes business. So potentially it could warrant higher valuations. But that's not the case going by the merger ratio, and that's why that stock as well is under some pressure. The key benefits that come in for the group on the whole is simplification of the group structure and synergy benefits. But getting to the key benefit then, as of now, Tata Steel Longs and Metallics, they procure their iron ore from Tata Steel. they have to pay additional 22.5% royalty on this purchase. Now, that gets eliminated post the merger. Additionally, Tata Steel Long's balance sheet, well, it got stretched post the NINL acquisition. So the merger is a step in the right direction. We spoke to the management earlier today, and Mr. Kaushik Chatterjee said that the merger will be EPS accretive, and also said that there will be more than 1,500 crores of potential cost savings and synergies due to this amalgamation. Bulk of it obviously will be the savings on the royalty aspect, which I just explained. Well, on that note, let's hear out what the management had to tell us earlier today.
After successfully merging and integrating Bhushan Steel, it was logical for us to look at the other subsidiaries which are of strategic relevance. And I think with these companies, all of these companies have, the businesses actually have a great future going forward. So first of all, it will be a simplification. And we have in the last 4-5 years taken out across Tata Steel Group about 120 companies. All of these are obviously EPS accretive for Tata Steel standalone. On the other hand, all of these were anyway consolidated because these are all subsidiaries. So after we the minority shareholders, the minority interest part gets absorbed. But otherwise, they were on its own already being part of the consolidated balance sheet of Tata Steel. So that's less of a point. The more important point is to drive the business in the future. And I think that is what will reflect very clearly on the Tata Steel balance sheet. And when I say Tata Steel, I'm always looking at consolidated balance sheet because that's the most relevant one. Annually, the annual number is close to 700-800 crores.
So I'm assuming that if this was a benefit of 700-800 crores, and if that's less than 50% of the benefit, then overall the synergy benefits will be in excess of around 1,500 crores.
On an NPV basis.
All right, that is the word coming in from the Tata Steel management on this mega consolidation. But with that, we're going to get into a short break. On the other side, Suprajit Engineering is on our radar. There's a brokerage note by MK, and they've initiated a buy call. So we'll be speaking with the management when we come back.
Welcome back. Suprajit Engineering is a stock and the company on our radar. MK initiated coverage in the stock earlier this week. It was a buy recommendation. They're forecasting a revenue growth of 25% over FY22 to FY25. To discuss the business outlook, we're now joined by Mr. Ajit Kumar Rai, founder and chairman of Suprajit Engineering. Mr. Rai, morning, and thanks for joining in. This is Rima here. Wanted to understand your outlook for exports. Exports, I believe, is about 40% of your overall revenues. We've heard from the likes of large U.S. auto companies like Ford saying that, they're going to face an impact of nearly $1 billion in terms of cost, far more than what they were earlier anticipating. And the fear is that it's not going to be restricted just to Ford. Maybe others like General Motors, etc., could also be facing an impact, due to weak demand as well as inflationary costs, still supply shortages, etc. Can you talk about the export outlook and what is it that you're seeing in terms of a demand from U.S., Europe, and your key clients?
Good morning, and thank you for having me on your channel. Yes, globally, there is a threat of recession, which is very true and very, very imminent, actually. But what I have been hearing from my own marketing and business development team, particularly in the automotive space, is that right now, there is a huge backlog of requirement from the customers. Thanks to the chip shortage and production constraints, etc., both due to COVID and also due to supply chain issues. there has been a tremendous vacuum in the supply chain at the consumer end in terms of the distribution setup. So today, every car, I was just talking to our president of US this morning, and he said that any car that has been manufactured here today has already been sold in some distribution channel. So there is a good demand in there, but there is a manufacturing constraints. I think it's a question of time when these manufacturing constraints relating to the components and chip shortages are overcome and the supply chain gears up to the requirement of OEMs. I think those pent-up demands will be there, and I think that would add to the tailwind that we are facing. Our tailwind that we are facing is also due to the new businesses that we are getting. So when you're adding 1 plus 1, I think it's going to be a very strong pipeline for us going forward.
Facing any production manufacturing constraints, and could you tell us the quantum if yes?
No, we do not have any manufacturing constraints. Of course, we are still having certain constraints regarding the IC chips because some of the assemblies where we use the IC chips, we have certain shortages. But for us, it is not a big problem. I think it is a problem for the manufacturers, like the automakers themselves, which is a major issue, I think.
Okay, so could you tell us then what is the kind of growth that you're looking at, Mr. Rai, for the full year? If you can tell us the note that Rima was just pointing out said around 20 to 25%. Do you think that's a fair estimate?
I mean, we don't really give such a long-term futuristic numbers. All we have been guiding consistently has been that we will probably outperform the industry by about 10%. I think which is easily doable for this year. What is also important is that this year we'll have a big spike in our growth thanks to the acquisition of LDC, which will add another nearly 700-800 crores of business to us in this financial year. And from the last year's position for the next 5 years, because of that spike, that kind of a growth is possible. Also due to the fact that we believe that once these chip issues are resolved fully, there will be a good volume growth as well in the US market. Although European market is somewhat tepid due to various other reasons.
Okay. Hi, Mr. Rai. Good morning. I wanted to speak about your manufacturing because we understand that you have moved your low-value, high-volume manufacturing to Indian plants and the more specialized procedures being done overseas. So could you give us a sense of what kind of savings this has been in terms of costs?
Just to give a little larger perspective, we had 5 years ago acquired Westcon with its plants in the US and Mexico, and now LDC with their plants in Mexico, Hungary, and China. What we are currently doing is what is best for the group in terms of restructuring. In the process of that restructuring, we are finding that the synergies and better values of respective plants will have to be respected, and we want to reorient our manufacturing lines in line with the strengths of respective plants. You are right, mass manufacturing has certain advantages in India, and I think we are leveraging that by approaching to the customer saying that we'll be able to give them better value by moving some of those businesses to India. But it is not across the board. It's ultimately customer-centric. If customer is preferring a better value, having the supply chain issues of supplies from India to say Europe and US, which is also a challenge today, they take the call, and accordingly we work. But yes, there is a move, in fact, particularly in the automotive as well as non-automotive businesses, larger volumes of, wherever the volumes are larger, the opportunities to do it in India with a better margin does exist, and we are leveraging that.
Okay, and since we're talking about this lowering of costs, can you tell us what it will really mean for your margins going forward and how much of an improvement do you see? Because for Q1, we saw around 480 bips margin compression as well.
Yeah, I think some of the things that will happen as we go forward because of this restructuring and reorientation of manufacturing is that it will add on to our margin. But of course, as you rightly said, we have also lost some margins thanks to the steep increase in energy, material, and other costs. So it will offset some of those costs. So we'll continue to be able to deliver the margins that we enjoyed historically going forward once these restructuring and all is completed.
Would that number be, and by when do you think you will be able to achieve that?
See, actually, if you take ex-LDC, without LDC, we are still at about 13.5% margin. Our guidance has been 14 to 15%. So we are very much there in terms of without LDC. LDC being a new acquisition, we have given a detailed brief on this, saying that is adding a little bit of stress on the margin, but that is a year's pain, which is required to re-strengthen and restructure LDC. Once that is done by end of next year, LDC margins, along with the India margins, will be easily in the double digits.
So FY24 margins on a consolidated basis will be in double digits, right?
Yes. And end of next year, we'll be very much there. Probably even before that, yes.
Okay.
All right, Mr. Rai, thank you very much, sir, for joining in and for explaining to us where things stand right now. We're going to take a very quick break. As we do that, here's some great news for investors. You can now track U.S. market action real time on Money Control. All you have to do is log on to the Money Control website or app, and you can stay informed about all that matters in the global markets. Hi, welcome back. Let's keep the focus on the market and get you some important market opinion that's coming from Ambit Capital's Dheeraj Agarwal.
IT is exposed to global markets, particularly the US, and despite the fact that IT stocks are down between 30-35% in the last 6 or 8 months, if one looks at valuations, they are still about 20% premium to the average valuations pre-COVID levels, whereas the growth is actually trending back to its normal pre-COVID levels. The bump that we saw during 21-22 is actually normalizing very, very fast, both on growth and margins. There is a weaker global demand, there is slide in metal prices, but this is very, very different from other metal recessionary trends that we have seen in the last 25 years. In every other previous weakness cycle for metals, the metal companies typically tend to drop into losses because of high amount of leverage on the balance sheet and very poor cost management. As compared to that, let's say Tata Steel, the name that you quoted. Tata Steel in this down cycle will still make more than 10% ROE. So typically metal stocks, if you buy in a down cycle and just hold it for some time with patience, you make a lot of money. We think that the worst of the outflows is behind. So if you see cumulative outflows between October and till June or July of this year, FI sold roughly 230-240 basis points of India's market cap, which is actually slightly higher than the net selling that we saw during the GFC months, which was also around about 200 basis points of India's market cap. So, I mean, 2 data points doesn't make it a trend, but I think it's fair to say that bulk of the froth, hot money, profit booking, leverage money, whatever you call it, is probably taken out. But at the same time, I would like to caution that the strong inflows of $8-9 billion that we saw between August and first half September, that pace also may not continue.
All right, that is some market opinion that we're tracking. But let's also quickly take a look at the markets. There's been a little bit of a recovery, around 45 points from the day's low. So it's currently around a 170-point cut that we are seeing on the Nifty, around 0.9% lower. But it is the Nifty Bank, which is still under severe pressure, seeing a cut of 830 points. What has moved up in the past couple of minutes? Well, you have Ultratech Cement, which is at the high point of the day. Wipro is at the high point. You have TCS also, which is doing quite well and holding up well. And like we've been pointing out, it is really the entire FMCG pack which is holding up once again. So the FMCG stocks, as well as some from the pharma space, really helping to keep some kind of support on this market. So that's what's going on. We're going to quickly wind down on the show now. Thanks a lot for tuning into Trading Hour. We have halftime report coming up for you after this short break.